Welcome back to the Deep Dive. We're the show that, well, digs through the data, the reports, the sources, so you don't have to. We give you that shortcut to being really informed. And today, we're starting with something that honestly made me do a double take. A source mentioning StoneCo noted this: 4,005%, 5-year potential upside. How?
Yeah, that's not just optimistic, that's a huge number. It really demands a closer look, doesn't it? How do they get there?
Exactly. So, to try and unravel that how, we're focusing today on StoneCo Ltd. You probably know them. They trade on NASDAQ, ticker STNE. They're a big name, especially if you follow fintech or software. Based in the Cayman Islands, but their real action is in Brazil. They've traditionally offered, a wide range of financial services, software solutions in-store, mobile, online, the whole package.
But, and this is the key thing, the StoneCo of maybe a year or two ago isn't quite the StoneCo of today. They're actively changing shape.
Right, and that's where our main source comes in their unaudited interim condensed consolidated financial statements. This is for June 30, 2025. We also have all the supporting notes, which are, frankly, just as important.
Now, unaudited interim, some people might think, oh, it's not the final audited word. But when a company is moving as fast as StoneCo seems to be, these interim reports are crucial.
They really are. They gave this incredibly timely snapshot, almost real time in corporate terms. You see the shifts in financial health, the operational changes, and critically, the strategy taking shape. So our mission today, go way beyond just reciting numbers. We want to figure out what these figures actually mean for StoneCo, obviously, but also for you listening in, trying to make sense of this market.
We're trying to dissect the how. What are the underlying moves, the financial mechanics that could possibly justify a projection that bold? It's about understanding the foundation.
It's definitely ambitious. But you're right, the financials are where we have to start. And what strikes me immediately is how upfront they are about these big strategic decisions, divestitures, acquisitions. They're not footnotes. They're reshaping the company.
Absolutely. It's fascinating how these choices are redefining their whole operational footprint. It's spelled out right there in the financial review. This isn't tinkering around the edges. It feels like a deliberate resculpting.
Okay, let's unpack that straight away. StoneCo is definitely not sitting still. You look at their recent actions, and there's a very clear strategy emerging. They're reshaping the business, and the numbers really bring that to light.
It's a bold strategy, too. Shedding major parts of your operation, especially parts you were known for. That takes conviction.
It really does.
Yeah.
And the biggest piece of this, the thing that jumps out from the financials, is this focus on discontinued operations.
Exactly. That's the headline strategic move here. They've formally classified a huge chunk of their software portfolio, Linksys, Sistemas, eConsultoria Lotida, a bunch of other software assets they call software businesses, and also Simplesvet Technologia SA, or Simplesvet. They've classified all of these as held for sale and discontinued operations.
And just to be clear, this isn't just internal jargon, right? This has real accounting and strategic meaning.
Oh, absolutely. It's a formal declaration. Ernst & Young, in their review report, even highlighted it. It triggered a significant change in accounting policy for these investments. They're now treated as non-current assets held for sale. It basically means they're already separated financially and mentally from the core ongoing business.
So what exactly are these software businesses they're divesting? Give us a sense of the scale here.
It's quite a list. You've got Links Telecomunicações, Sponte Educação, that's education software, NAPS SRL, and its operations across Latin America, focusing on retail software, Synthesis Holding. I mean, it's not just one or two small ventures. It's a substantial, diverse portfolio across different industries. It really signals a clear exit from being a broad multi-industry software provider.
Okay, so they draw this line in the sand. Discontinued operations. From an accounting view, why is that separation so important? How does it help us as listeners understand what's really going on?
It's all about clarity. This classification forces them to present the results, the profit or loss from their continuing operations separately from these discontinued ones.
Right.
And here's the kicker. They have to restate the prior periods, too, for comparison. So you get this clean, almost purified view of the core business they intend to keep and grow.
So you can actually compare apples to apples, see how the ongoing part of StoneCo is doing without the noise from the bits they're selling off.
Precisely. It strips away the distraction. You see the performance of what management considers the future of the company. That transparency is absolutely fundamental if you're trying to gauge long-term potential.
Makes sense. And practically speaking, how did this play out? Did they just earmark these businesses, or did the sales actually happen? What were the values involved?
Well, first, the valuation. As of June 30th, 2025, the carrying amount of these businesses held for sale was significant, about $3.6 billion. Management did their homework, assessed the recoverable amount, and interestingly found no impairment loss.
Meaning they weren't selling them off cheap because they were failing.
Exactly. In fact, the estimated fair value less cost to sell actually exceeded the carrying amount, so they were likely getting a decent price. And yes, this wasn't just a plan, it happened fast. The subsequent events note confirms deals were signed in July 2025.
Okay, who bought them?
The main chunk, the software businesses, went to Totvs SA, a big player in Brazilian software, for about $3.05 billion, plus around $360 million in estimated net cash. And SimplesVet, the veterinary software part, was sold to Petlove Tecnologia Ltda for an enterprise value of $140 million.
So, big disposals. For our listeners, thinking about StoneCo's identity, shedding these significant, pretty diverse software assets, what does it signal? Is it just streamlining, getting rid of less profitable bits? Or is it something more fundamental about who they want to be? It really challenges that old financial services and software solutions provider label, doesn't it?
It absolutely does. It signals a strategic sharpening. They're moving away from that broad, maybe somewhat unfocused software strategy, but critically, it's not an abandonment of software altogether.
Ah, okay. So what's the nuance there?
The nuance is they seem to be pivoting towards targeted software solutions, software that's deeply intertwined with their core financial services. That's a crucial distinction. And we see evidence of this on the other side of the coin, the acquisition side.
Right, because while they were selling off Lynx and the others, they were also buying or increasing their stake in something else.
Exactly. Contrasting the divestitures, one of StoneCo's subsidiaries, STNE Participações SA, made a key move. On April 4th, 2025, it bought more shares in a company called APP. They already owned some, but this pushed their stake up to nearly 46%, 45.96% to be precise, and crucially, gave them control.
And what does APP do? What's their niche?
APP is an unlisted company based in São Paulo. They develop integrated management solutions, but their focus is primarily on the hospitality segment. So think hotels, restaurants, that kind of business.
Okay, that is specific. So shedding broad software, but doubling down on hospitality software. What were the financials of that APP deal?
The total cash paid for that additional stake was just over $12 million. The deal resulted in about $8.3 million in goodwill. That's the premium paid over the identifiable assets, reflecting things like brand, customer relationships, expected synergies.
The intangible value.
Precisely. And there was also a gain recognized about $2 million from remeasuring the value of the stake they already held in APP. When you gain control, you have to revalue your previous investment to fair market value at that point. The whole thing signals they see real strategic value in APP.
So this selective acquisition, focusing on hospitality, it really does paint a picture of a much more refined strategy, offloading the general stuff, deepening the stake in a specific vertical. For you, our listener, what does this tell us about StoneCo's long-term vision for software? Is it vertical integration, a focus on niche markets where they can bundle payments and software?
I think it clearly points towards a more concentrated, vertically integrated approach. Hospitality in Brazil, like everywhere, is digitizing rapidly booking, management, payments, everything. APP provides those management tools.
And StoneCo provides the payment rails.
Exactly. By getting control of APP, StoneCo isn't just a vendor processing payments for these hotels and restaurants. They can become an essential operational partner, embed their financial services right into the software these businesses run on every day. That creates a really sticky ecosystem.
Much stickier than just being the payment processor.
Much stickier, and potentially much more profitable. This targeted play in a specific growing niche, leveraging their core payment strength that feels like a much more defensible, potentially high-growth strategy than the previous broad approach. It could absolutely be a key driver of that long-term upside potential.
Fascinating. So these strategic chess moves are clear. Repositioning, focusing. But as always, the proof is in the pudding, right? How does this translate into the actual financial performance? What do the profit and loss statements show us, especially with that crucial split between continuing and discontinued operations?
Precisely. That separation is gold here. It lets us see the underlying health of the new, refocused StoneCo. And the picture for their continuing operations, looking at the first 6 months of 2025, is genuinely strong.
Okay, give us the headline numbers.
Total revenue and income from these continuing operations hit $6.86 billion. That's a significant jump, up 20.6% from $5.69 billion in the same period in 2024. That's robust growth in the core business they're keeping.
And where's that growth coming from specifically within the continuing operations?
Okay, breaking it down, the biggest driver and the fastest growing is financial income. That reached R 4.71 billion thousand in the first half of 2025. That's up a very strong 32.1% from R 3.57 billion thousand the previous year. This is fueled by their payment processing volumes, their banking solutions, interest on client funds, their credit offerings.
So the core financial engine is really humming.
It really is. Then you have net revenue from transaction activities and other services. That hit our 1.32 billion thousand. Also showing strong growth compared to Q2 2024, although there's a slight complexity comparing it to the 3 months ended June 30, 2024 because of the recasting for discontinued ops, but the trend is clearly up.
And the third piece, subscription and equipment.
Right. Net revenue from subscription services and equipment rental, think payment terminal rentals, the remaining integrated software fees that climb to our 435 million thousand from our 359 million thousand, a solid 21.3% increase. So growth across all key areas of the continuing business.
That's definitely impressive growth on the top line for the core business. Is it translating down to the bottom line? Are they keeping more of that revenue as profit?
Yes, the net income story is also positive. Net income from continuing operations reached R $1.1 billion for the 6 months. That's a solid 29.5% improvement from R $849 million thousand in 2024.
Okay, that's a healthy jump.
And specifically, the slice attributable to the controlling shareholders, the bottom line for StoneCo's owners, also rose substantially. It went up to 1.09 billion thousand from R 848 million thousand. So yes, it's not just revenue growth, it's profitable growth flowing through from that strategically refined core business.
That kind of focused, profitable growth.
Yeah.
You can see how that starts to build the case for a potential re-rating or that significant upside down the line.
Absolutely.
Now, that's a continuing story, which looks good. But we also need to understand what they actually lost by divesting those other businesses. What was the financial contribution of the discontinued operations? Does it help justify the decision to sell them?
It does, I think. Looking at the numbers for those discontinued operations for the first half of 2025, they generated about a 616 million thousand in total revenue. That was slightly up from about 599 million thousand in 2024. So these were definitely active businesses generating sales.
Mostly from software subscriptions, I assume.
Primarily, yes. Net revenue from subscription services and equipment rental was the biggest chunk, around R 555 million thousand. But here's the key contrast. Their net income for the period was only about R 21 million thousand. And that was actually down slightly from R 23 million thousand in 2024.
Okay. So decent revenue, but much, much lower profitability compared to the core business.
Exactly. A stark difference. While they were contributing to the top line, their profit margins were significantly thinner than the continuing operations. That really helps explain the strategic rationale why focus resources there when the core financial and integrated software business is delivering much stronger, higher margin growth.
So for you listening, understanding these numbers helps grasp the scale, yes, but more importantly, the relative profitability of what they sold off. It wasn't just shedding assets, it was shedding lower margin assets to double down on the high-performing core. It powerfully highlights how well that core is actually doing.
And this comes through clearly in the earnings per share, the EPS figures, which often resonate more directly with investors. Basic EPS from continuing operations jumped significantly from our $2.75 in the first half of 2024 to our $3.99 in 2025.
That's a big leap, over 45% increase.
It is. Reflects both the higher net income and maybe some impact from share buybacks, which we'll get to. Now, compare that to the discontinued operations. Their basic EPS was stable, but low, just $3.07 for the first half of 2025. Same as 2024, though it was up from a small loss in Q2 24 alone. That low, flat contribution further justifies the divestment.
And diluted EPS.
Same story. Similar story for diluted EPS from continuing operations. It also jumped about 45% from our $2.69 to our $3.90. These per-share metrics just hammer home the improving profitability and efficiency of the core business post-restructuring. It shows how these strategic moves are directly impacting shareholder value metrics.
One quick sanity check, though, seasonality. Does that play a big role for StoneCo? Could these strong first-half numbers be skewed?
That's a very important point. Yes, StoneCo explicitly notes that their revenues are seasonal. Historically, the fourth quarter is their strongest, think holiday season, Black Friday, increased spending in Brazil. So while these first half results show excellent momentum, you can't just double them to predict the full year. It's a crucial caveat. Keep that Q4 bump in mind.
All right. Good context. Okay, moving from income and profit to the fundamental structure of the balance sheet. This is where it gets really interesting, digging into what StoneCo actually owns and owes as of June 30th. This snapshot is key to understanding their financial health, especially with all these moving parts.
Absolutely. The statement of financial position, the balance sheet, really lays bare the structural changes from these strategic decisions. It shows how they're managing capital, valuing assets, handling liabilities. It's the foundation.
So let's start with the assets. What does StoneCo possess? What's the overall picture?
Overall, total assets grew quite healthily. They went from about 46 billion thousand at the end of 2024 to nearly our 50 billion thousand, our 49.7 billion dollars, let's say by June 30, 2025. That's a solid 8% increase in just 6 months.
But right away, we see that strategic shift reflected, right? That new line item.
Exactly. Smack bang on the balance sheet is this new significant line. Assets classified as held for sale. It stands at R 4.35 billion thousand as of June 30th, up from zero previously. This is the direct financial reflection of Lynx, Simple's Vet, and the others being earmarked for sale.
What makes up that our $4.35 billion? Is it mostly intangible stuff like software value?
A large chunk of it is, yes. Intangible assets make up about our $3.6 billion of that total. Think software licenses, customer lists, brand value tied to those departing businesses. There's also about our $68 million in property and equipment. It gives you a clear measure of the value tied up in those segments they're divesting.
That's a very visible marker of the strategy. What else jumps out on the asset side that tells us about the health of the continuing StoneCo?
Okay, two really interesting movements. First, a big jump in accounts receivable from card issuers. This went up significantly by nearly 23%, from our 29.2 billion thousand to our 35.9 billion thousand.
And that's basically money owed to StoneCo for transactions they've processed.
Precisely. It's money due from Visa, MasterCard, etc. for the transactions of StoneCo's clients. Such a large increase is a direct reflection of the strong growth in their core payment processing volume. More business is flowing through their pipes.
Okay, that's a positive indicator. What was the other interesting movement?
The other one moved sharply in the opposite direction. Financial assets from banking solutions saw a dramatic decrease. Fell from 8.8 billion thousand down to our 1.6 billion thousand.
Wow, that's a huge drop. Why? And is that a concern?
It's a big drop, but the context is important. These assets are fully collateralized by something called the Electronic Money Correspondent Account, or CCME. This is a regulatory requirement from the Brazilian Central Bank, Basin.
Okay, you mentioned CCME earlier. Can you just quickly explain what that is and why fully collateralized matters here? Sounds important for a fintech in Brazil.
It's absolutely critical. The CCME isn't just an account. It's a specific type of segregated account mandated by Basin. It's designed purely to protect client funds held by payment institutions like StoneCo. These funds must be kept separate from the company's own money.
Like a ring-fenced account.
Exactly. And fully collateralized means these specific financial assets on StoneCo's balance sheet are entirely set aside, earmarked, to cover those client liabilities held in the CCME. It's a key layer of security, demonstrates strict compliance, and builds trust. So the decrease here isn't necessarily a sign of weakness. It's more likely a rebalancing or reoptimization of how they manage capital within that strict regulatory framework, maybe shifting funds elsewhere on the balance sheet.
Got it. So not necessarily a red flag, more a reflection of capital management within regulations. What about their lending activities? You mentioned the credit portfolio earlier.
All right, the credit portfolio showed significant growth. The net portfolio jumped 48% from 1.06 billion thousand to our 1.57 billion thousand. This signals they're actively expanding their lending to merchants, offering more than just payment processing.
With more lending comes more risk, though. How are they managing that? What about non-performing loans, NPLs?
Good question. The notes provide detail on NPLs and aging. Encouragingly, the total balances not overdue in the merchant portfolio actually increased, suggesting the quality of new lending is holding up. But they are also very proactive about potential losses. They use a sophisticated three-stage model for calculating their expected credit loss allowance, or ECL.
Okay, ECL. Can you break down that three-stage model? How does it help them manage risk with this growing loan book? Sounds like something listeners tracking fintech would want to understand.
Definitely. The ECL model under IFRS 9 accounting rules is much more forward-looking than older methods. Stage 1 is for loans where credit risk hasn't increased significantly since they were originated. For these, they recognize a 12-month expected credit loss. Think standard provisioning. Stage 2 is for loans where the credit risk has increased significantly. Maybe a borrower missed a payment or their financial situation worsened, but the loan isn't actually impaired yet. For these, StoneCo has to recognize lifetime expected credit losses. Much more conservative.
And stage 3?
Stage 3 is for loans that are actually credit impaired, basically. They have objective evidence of default. Here, they also recognize lifetime ECLs, and the way they account for interest income changes too. It forces them to be proactive and provision for potential losses much earlier.
So it's a much more dynamic and forward-looking way to assess risk than just waiting for loans to go bad.
Exactly. It reflects a more sophisticated, prudent risk management framework. And we do see their ECL allowance increasing, which makes sense given the portfolio growth and the need to account for potential future risks.
Yeah, it's reassuring. So even as they divest broad software, they still have significant intangible assets related to the core business.
Oh, yes. Even after transferring a big chunk to assets held for sale, the continuing operations still hold substantial intangible assets. There's goodwill of about $675 million, mostly from past acquisitions aligned with the core strategy. There's software valued at nearly $919 million. That's their proprietary payment platforms, the remaining integrated solutions like APP, and customer relationships valued at $173 million.
So the software solutions provider identity is still there, just much more focused and integrated.
Precisely. It's refined, strategically aligned, geared towards enhancing their core financial services.
Okay, let's flip to the other side of the balance sheet liabilities. What does StoneCo owe? Any major shifts there?
Total liabilities saw a fairly modest increase, about 1.3%, rising from roughly $43 billion to $43.5 billion. And mirroring the asset side, there's that new line, liabilities associated with assets held for sale amounting to about $757 million. That covers the obligations of the businesses being sold.
Makes sense. Keeps it clean. What about the big liability items for a company like this? Deposits, funding, anything interesting happening with retail deposits?
Ah, yes. This is where we see some really clever internal maneuvering. The headline number for retail deposits looks fairly stable, around $8.8 billion, but underneath there's a dramatic shift.
How so?
The line item deposits from retail clients, basically money sitting in standard payment accounts, actually decreased massively from $8.3 billion down to $1.5 billion. But simultaneously, time deposits from retail clients skyrocketed from just $430 million up to $7.3 billion then.
Whoa. So the money didn't leave StoneCo, it just moved from one type of deposit account to another. Why?
It's a smart strategy they implemented starting in Q1 2025. Balances sitting in client payment accounts are now automatically swept daily into time deposits issued by their own financial institution subsidiary, Stone SCFI. And these time deposits yield up to 100% of the CDI rate.
Okay, CDI again. Remind us what that is and why offering 100% of it is significant. Sounds a good deal for clients.
It is a very good deal for clients. CDI, the Certificado de Depósito Interbancário, is Brazil's key interbank lending rate, the benchmark for short-term interest rates like the Fed funds rate in the U.S. Offering up to 100% of CDI is highly competitive for what are essentially cash balances.
So what's the benefit for StoneCo? Why do this?
It's a win-win. Clients get a great return on their idle cash, making the StoneCo platform stickier and more attractive. And for StoneCo, it likely stabilizes their funding base and potentially optimizes their own funding costs, as time deposits might have different regulatory or internal treatments compared to demand deposits. It's very astute capital management within the group.
Very clever. Turning client cash into a more stable, potentially cheaper funding source while giving clients a better return. What about other funding sources, like from institutions or debt markets?
They've been active there too. Institutional deposits and marketable debt securities increased from $8.5 billion to $9.3 billion. This includes their first issuance of financial bill short-term debt by Stone SCFI, plus new time deposits from various institutional counterparties.
And didn't you mention a significant international investment?
Yes, that's a key detail here. They secured a substantial investment from the U.S. International Development Finance Corporation, the DFC, U.S. $467.5 million. This isn't just general funding. It's specifically earmarked to support StoneCo's prepayment business, channeled through a specific investment fund called FIDC ACRI.
Getting that kind of backing from a major U.S. development finance institution, that's a pretty strong vote of confidence, isn't it?
It absolutely is. It signals credibility and alignment with development goals, likely focused on supporting small and medium-sized businesses in Brazil through StoneCo's platform. It's a significant validation.
Okay. What about derivatives? We see that liability increased. Is that a sign of increased risk-taking?
The net liability position on derivative financial instruments did increase from about R32 million thousand to 384 million thousand, but the notes are very clear. These are primarily used for hedging, specifically hedging foreign currency and interest rate risks.
So managing risk, not speculating.
Exactly. Their risk management area handles this, following board-approved policies. The increase likely reflects more active hedging in response to market volatility or increased underlying exposure, which is actually prudent risk management, not reckless speculation. And finally, on liabilities, the provision for contingencies for potential legal losses remains stable at $186 million thousand.
Okay, so summing up the balance sheet picture, we see assets growing, clear evidence of the strategic divestments, strong growth in core receivables, a rapidly expanding but seemingly well-managed credit portfolio, very clever internal management of retail deposits, diverse institutional funding, including that DFC backing, and prudent risk management through hedging. It paints a picture of active, dynamic financial management supporting the core strategy.
That's a great summary. They're clearly optimizing resources to fuel that focused growth.
Now let's look at equity, the shareholder slice of the pie. Any major changes there? How is shareholder value being treated amidst all this?
Well, the headline, total equity attributable to controlling shareholders, actually saw a slight decrease from our $11.8 billion down to 11.6 billion thousand between December 24 and June 25. But the really interesting story within equity is treasury shares.
Shares the companies bought back from the market.
Exactly. And the value of these held shares increased significantly from $1.8 billion to our 2.9 billion thousand. This reflects some very aggressive share repurchase activity.
How aggressive?
In just those 6 months, StoneCo repurchased nearly 21 million Class A shares, spending a hefty 1.24 billion thousand to do so. This was all under board-approved buyback programs. That's a massive deployment of capital back to shareholders. And just to note, some shares also go out the door for things like employee RSU awards vesting or non-compete agreements, which is standard practice, but the buybacks are the big driver here.
So for you, our listener, seeing this level of treasury share activity is really telling. It strongly suggests management believes their own stock is undervalued, using over $1 billion raise in 6 months to buy back shares. That's a powerful signal of confidence in the company's intrinsic value and future prospects.
It's a direct way to return capital and potentially boost EPS by reducing the share count. It aligns with that focus on driving shareholder value, a core component of achieving that massive potential upside we started with.
Okay, we've looked at what they own, what they owe, and how the strategy is reshaping that picture. Now, let's follow the money itself, the cash flow statement. This tells the real story of liquidity, operational efficiency, and where the cash is actually coming from and going, especially crucial during a transformation like this.
I agree. If the balance sheet is a snapshot, cash flow is the movie. And it's arguably the most critical statement for understanding true financial strength and sustainability, particularly with StoneCo's major strategic shifts.
So starting with the core engine cash flow from operating activities, what's the story there?
The story there is, frankly, stunning. A major positive shift. For the first 6 months of 2025, net cash provided by operating activities was R1.01 billion thousand. Positive cash flow from the core business.
Okay, positive sounds good, but what was it before?
That's the stunning part. In the same period in 2024, they used R3.19 billion thousand in operating activities. So it swung from a massive cash drain to a strong cash inflow.
Wow, that's not just an improvement, that's a complete U-turn from negative R3.2 billion to positive R1 billion. What drove that incredible turnaround? What does it say about the resilience of the core business now?
It says the core refocused business is a powerful cash generation machine. A huge factor, as we saw hinted in the income statement, was the surge in interest income received, net of costs. That figure climbed dramatically, hitting our 3.3 billion thousand received in cash in the first half of 2025 compared to our $2.0 billion in 2024.
So that booming financial income is translating directly into cash in the door.
Directly. It reflects the growth in payments, banking, credit, all generating real cash. Better working capital management likely played a role too, along with various non-cash adjustments flowing through the reconciliation. But the fundamental driver is the sheer cash-generating power of that core financial services engine they focused on.
For you listening, this swing to strongly positive operating cash flow is maybe the single most important indicator of improving financial health. It shows the underlying business model post-divestiture is not just profitable on paper, but is actually throwing off significant cash. That provides robust internal funding for everything else they want to do.
Couldn't agree more. It's a fundamental sign of strength.
Okay, so the operations are now generating cash. How are they deploying it, or maybe generating cash, through investing activities? What's the picture there?
Investing activities show a shift in the other direction, net-net. Net cash used in investing activities was our $319 million in the first half of 2025. This contrasts with cash provided by investing activities of our $2.6 billion in the same period of 2024.
So they went from getting cash from investments to spending cash on investments. Does that mean they stopped investing in the business?
Not at all. They are still investing. We see continued purchases of property and equipment, about our $392 million spent, and intangible assets, about $215 million spent. So CapEx continues, supporting the core infrastructure, developing new features, enhancing their network.
So why the big swing in the net number then?
The main reason for the net shift was much lower, proceeds from short-term investments. In 2025, they only got about our $296 million from selling off short-term investments. In 2024, that figure was vastly higher at our $3.4 billion.
So in the prior year, they were selling off a lot more financial investments, which generated cash inflow in the investing section. Now, not so much.
Exactly. It correlates with that drop in short-term investments we saw on the balance sheet. It suggests they were liquidating more assets previously, maybe to fund operations or other needs. Now, with operating cash flow positive, they're perhaps holding investments longer or deploying capital differently.
So, for you, our listener, this shows StoneCo is still investing in its future growth buying equipment, developing software. But the overall cash flow from investing is changed because they're not selling off financial assets at the same rate. It's indicative of a different phase, perhaps less reliant on liquidating prior investments. Now, the final piece, financing activities. How are they managing debt, equity, and those buybacks from a cash perspective?
Financing activities also saw a dramatic reversal. Net cash used in financing was our $312 million in the first half of 2025. Again, a stark contrast to the our $3.1 billion provided by financing activities in the first half of 2024.
And the main driver here was?
Overwhelmingly, it was the share buybacks. That repurchase of owned shares line shows a cash outflow of our $1.24 billion in 2025. That dwarfs the our $237 million spent on buybacks in the same period of 2024.
That huge buyback program is really dominating the financing cash flow then.
Absolutely. It's the single biggest use of cash in this section. While they did raise significant cash from institutional deposits and other debt, nearly our $6 billion in proceeds, they also paid back over our $5.1 billion in loans and financing.
So a lot of churn in debt, but not a massive net inflow of new debt funding.
Right. It suggests active management of their debt profile refinancing, replacing facilities rather than relying heavily on new borrowing for funding. The net effect is relatively balanced, leaving the buybacks as the major cash outflow driver in financing.
So for you, our listener, that massive $1.24 billion cash outflow for share repurchases really underscores their commitment to returning capital and their belief in the stock's value. When you pair that with the strong positive operating cash flow, you see a company funding its shareholder returns largely from its own internal operations. That kind of capital discipline can be a powerful engine for future value creation and helps build the case for that long-term upside.
It paints a picture of a company generating cash and confidently reinvesting it in itself.
Okay, we've covered the strategy, the performance, the balance sheet, the cash flow. But sometimes the real devil or the hidden gem is in the details, the fine print. What lurking risks or opportunities are tucked away in the notes that could really impact StoneCo's future?
That's a crucial question. Beyond the core numbers, what external factors, what potential wildcards could swing things significantly? The notes definitely highlight a few key areas to watch.
Let's start with taxes. Always important, especially for an international company operating heavily in Brazil.
Right, so StoneCo is Cayman Islands based, no income tax there, but the real action is in Brazil, where the statutory income tax rate is currently 34%. That's the baseline.
But there's a potential change looming.
Yes, and it's significant. There's a provisional measure, an MP, number 1.3032025. Now, in Brazil, an MP is basically an executive decree that has immediate force but needs congressional approval to become permanent law, usually within 120 days.
Okay, and what does this MP propose?
It proposes to increase a specific tax called the Social Contribution on Net Income, or CSLL, and not just a small tweak. For key StoneCo subsidiaries, Stone IP, Stone SCFI, Stone SCD, this MP would potentially hike the effective rate from the current 34% up to somewhere between 40% and 45%.
Wow, that's a potential 6 to 11 percentage point jump in the tax rate for core parts of their business. That sounds like it could have a major impact on profits.
It absolutely could. Now, it's not baked into the current financials yet because it still needs that congressional approval to be considered substantially enacted. There's a legislative process. But if it passes, the higher CSLL rate could kick in as early as November 1st, 2025, with other related changes in 2026.
So this isn't some distant threat. It could impact results quite soon.
Potentially, yes. It would mean a direct hit to the bottom line. For every R$100 of profit those subsidiaries make, an extra R$6 to R$11 would go to taxes. It wouldn't change their operational efficiency, but it would reduce the net profit that flows through. Definitely a critical external factor to monitor in the coming months.
For you, our listener, this is a very real, forward-looking risk. It highlights how the political and regulatory environment in Brazil can directly impact financial outcomes, regardless of how well the core business performs. Keep an eye on the status of MP 1.303. What about legal issues, contingencies? Any landmines there?
Well, they do have provisions set aside for probable losses from various legal battles, civil, labor, tax, totaling about 186 million thousand. That's fairly standard for a large company.
Okay, provisions for things they expect to lose. What about things they might lose but haven't provisioned for?
That's where it gets more interesting. They disclose additional litigations where the risk of loss is deemed possible, but not probable enough to set aside cash for. These possible losses total a more substantial R$372 million thousand. It's spread across civil, labor, and tax cases.
Any particular area of concern within those possible losses?
Yes, the tax litigation piece saw a huge jump. It went from about R$42 million thousand at the end of 2024 up to nearly R$250 million thousand by June 2025.
Whoa, why the big increase?
It's due to a new municipal tax assessment. The allegation is about insufficient payment of tax on services rendered. So on top of the potential federal CSLL hike, they're facing increased scrutiny and potential liabilities at the municipal level, too. It highlights ongoing tax pressure.
That's a worrying trend on the tax front. Anything else significant lurking in the legal notes?
Yes. One other major item, there's an ongoing securities class action lawsuit. This relates back to their former credit product, so it's a legacy issue from before this big strategic refocus.
Okay, class actions can be messy. What's the status?
The parties are apparently talking, engaging in discussions for a potential resolution. But, and this is a key, StoneCo states they cannot yet reasonably quantify or estimate the potential damages.
Unquantifiable. That's always a red flag for investors, isn't it?
It absolutely is. It creates uncertainty. Even without a specific number, these things can drag on, cost a lot in legal fees, potentially damage reputation, and just hang over the stock, affecting sentiment and valuation, even if the core business is firing on all cylinders. It's a significant wild card.
So for you listening, while some legal tussles are normal, this unquantifiable class action and the big jump in potential tax liabilities are definitely details to watch. They represent financial risks that could materialize down the road and impact results. It underscores why looking beyond the core operations is so important.
Couldn't agree more.
Okay, we've really covered a lot of ground here. Journeyed through StoneCo's strategic transformation via their interim financials, the divestments, the refocusing, the core performance, the balance sheet health, the cash flow dynamics, and these critical fine print items. It's clear this isn't just about incremental change. They're forging a new path. So let's try to crystallize this. What are the absolute key takeaways you want our listener to walk away with, especially thinking back to that eye-popping 2,405% potential upside hook?
I think the most critical takeaway is that StoneCo is deep in a profound, very deliberate strategic transformation. They are actively shedding non-core, lower-margin assets to sharpen their focus laser-like on their high-performing core.
And that core is performing well.
Exceptionally well. The strong growth in continuing operations, particularly the profitability, and that dramatic positive turnaround in operating cash flow, these fundamentally underscore the health, resilience, and cash-generating power of that refocused core business. That's the engine that could, if sustained and scaled, potentially drive the kind of long-term value creation hinted at by that huge upside number, despite the noise of divestitures and external risks like potential tax hikes.
Okay, so let's recap those key insights. First, the strategic refocusing.
Absolutely. Clear strategy, divest broad software, links, symbols vet, acquire targeted integrated software, APP and hospitality. Streamline, strengthen focus on financial services plus deeply embedded specialized software. Become indispensable in key niches.
Second, robust core performance.
Yes. Significant double-digit growth in revenue and net income from the continuing operations. Shows the health, the profitability, the leverage, and the core engine they've chosen to keep and nurture.
Third, financial strength.
Evident in that massive positive swing in operating cash flow. Strong, self-sustaining cash generation. Reinforced by those huge share buybacks, signaling management confidence and commitment to returning value.
Fourth, dynamic capital management.
Definitely. That clever handling of retail deposits using CDI-linked time deposits. Proactively securing diverse funding, like that important DFC investment which provides validation. Smart, agile management of their resources.
And finally, fifth, watch for external factors.
Crucial reminder. Keep a close eye on that potential Brazilian tax rate increase, MP 1.303. And be aware of the ongoing unquantified risks from the securities class action and those increased possible tax assessments. StoneCo operates in a complex, dynamic environment.
That really pulls it all together. It's a picture of a company actively managing its destiny, leveraging its strengths, but also navigating real external pressures. It's not just about the numbers. It's the strategy and execution behind them.
Precisely. Which leads us naturally to a final provocative thought for you, our listener, to mull over.
Lay it on us.
Considering these deliberate divestitures, the focused investment in core finance and specialized software, the agile capital management, what does StoneCo's journey really tell us about the future of integrated fintech platforms, especially in dynamic, complex, emerging markets like Brazil? How will these profound shifts ultimately redefine StoneCo's own long-term upside as it tries to navigate both immense market opportunities and significant regulatory hurdles? Is this focused, integrated model the winning blueprint for fintech success in these highly competitive arenas?
A fascinating question. Does this strategic pivot set a new standard? And does it hold the key to unlocking that almost unbelievable potential upside we started with? StoneCo is definitely playing the long game. These interim financials offer a powerful window into the deliberate steps they're taking. Thank you for joining us on this deep dive into StoneCo's transformation. We hope you feel better informed, better equipped to think critically about this really interesting company and the broader fintech landscape. Until next time.